I'm David Elder, wealth manager at Merritt Financial Advisors. One of the reasons we're here today is really trying to bring to each of you some updates on your portfolio, maybe a little message about a planning strategy. Today, we're going to talk about investing in an election year, not necessarily because that's outside of the portfolio, but because we're getting a lot of interest and just finished doing a series on that. And then we'll talk with Sonya Martinez at the end, and she is a real estate agent. So that'll bring in kind of the real estate side of the guest speaker. And from an advanced planning standpoint, things to consider if you're putting that in, whether from an investment standpoint or other part of your financial picture. So with that, I'm going to go ahead and share my screen and get started. All right, so May update, Elite Wealth Management webinar. Okay, so here's going to be our agenda for the day. And this is what we follow on these monthly webinars every single month. And it's standing agenda because these things are always important if you think about them. It's investment management, what's going on with your accounts, the overall market, overall economy. I will do my little disclaimer here, which is we are talking in the broadest picture, not necessarily your specific account, but what we're talking about is issues that impact most of our clients. Advanced planning, we're going to try to bring on a monthly basis an idea to you guys about a financial planning idea outside of investments that you may or may not have considered. A lot of times it's tax mitigation, estate planning, charitable giving, asset protection, those types of things. This month we'll actually be doing investing in election years. Next month we are going to actually be doing travel insurance, sort of for summer travel insurance season. And then if there's any other topics y'all would like or good ideas there, please let us know. In the relationship management, we'll be interviewing Sonya Martinez, who's a real estate agent in this area and thought she could bring us some interesting perspective on what's happening in those markets, because they're obviously a little different than these publicly traded ones that we use with most of y'all's portfolios that we're discussing. So go ahead and jump into kind of where we're at on the investment side. One thing I would say we've been looking at, and this is always true, and one of the things I'm now starting to feel like a broken record, but that makes me feel like I'm being a consistent record, and hopefully that's a good way to serve you all, is that I will often say in finance, it's always easy to say how something or why something might occur. It's nearly impossible to say when. And let that sink in. So what we have here is a market-focused prediction of where the Fed funds rate via futures markets will be by the end of this year. And one thing that's been this story over and over again in this current cycle we're in, which I still say, depending on how you look at it, and we may be in a new cycle soon, but I think this is still starting from COVID, coming back and kind of cooling down after that. And we might be in the middle of a soft landing for all we know. But what we're looking at from an investment standpoint isn't just the economic data, but what are the outcomes and how might that impact our portfolio? And I'll give you a good example. If we take interest rates where they are right now, in a lot of ways, if we believe they're going higher, I might want to invest one way, but if I think they're going to stay the same or possibly go lower, I might want to invest a different way. Now, a lot of that is what window are you looking in? Is it a 3-year window, a 5-year window? Because they could very well, see, I started echoing there. Oh, it can very well go higher before it goes lower, but we think eventually it will most likely go lower. And the market's saying that too. So here is, and this is hundreds of basis points, 400 basis points up to 550. So that's 4% up to 5.5%. A basis point, for those of y'all that aren't familiar with this, if we look at something like 475 basis points, that just means 4.75%. So what the average market participant thinks is the market is pricing in a Fed funds rate of somewhere around 450 to 500 basis points by the end of the year. Maybe as low as 425, but I would say right here is your general consensus. And then down here you have a few outliers, but what you see is in general, most people are thinking that in the future the Fed rate will come down. And there's a lot of arguments and a lot of reasons why it should come down, a lot of arguments and a lot of reasons why it shouldn't. You can come up with why it should stay high. We don't care because we can't control that. What we care about is, depending on where it goes, how does that dictate your portfolio? And a lot of times what we'll do is some stress testing, and when we watch performance, do things like, all right, how's this going to perform if interest rates climb versus how's this going to perform if interest rates go down, and watch things in perspective of that. So we are gearing up to not necessarily ever say when, but to be ready to be in a position to take off with things like fixed income, growth stocks, et cetera, if rates start going down, which the market predicts they will. Also, one change we've made in the last 60 days for pretty much everybody across the board, unless you had some locked positions or other things, is just decreasing international exposure. And with that, China specifically, second largest economy in the world. Because of that, you can't completely ignore it. But I mean, my gosh, when you look at their per capita GDP, it's just horrible. And, the soft real estate situation, kind of the economic fights we're in, we just thought it would be wise for a little while to take that posturing. And maybe at some point in the future, we'll go back to neutral. But for right now, we are intentionally lowering real estate in favor of real estate. I'm so sorry. My mind's already to Sonya. Lowering exposure to China and in favor of the United States. All right, and so there's not a lot of changes, as I told you this month, but what I do want to keep y'all in mind is kind of the process on these investments, because people often ask, and some of these changes that I'm talking about are what we planned at the beginning of the month, not even what we're thinking about now. Y'all will see some fixed income fund swaps that have happened since we got this through compliance, but all the time, how do we do the investment decisions? So I thought I'd take y'all through sort of our process in sort of a step-by-step basis. And really, you have to put all 6 of these criteria together when evaluating an investment, because often people look at investments in siloed buckets or just on the return, not realizing that that can tell you either the wrong perception if you look at what happened in the rearview mirror, or maybe it works great by itself, but it relates and correlates strange with this other asset in your portfolio. And so, for example, if I have a share of Amazon stock and I go out and buy a share of Nvidia, well, that's great. Both are probably going to make more money for my portfolio than a bond, but at the same time, those two correlate a lot. So if I want the highest return, I might have made the good decision there. But if I want to de-risk a little bit, I may go out and buy a less expensive or less growth-oriented company, maybe a Coca-Cola, or even go all the way down and say, you know what, maybe I'll buy that Amazon stock and some bonds to pair it with. So that type of process. So first of all, long-term capital market assumptions. What do we think is going to happen over the next 5 to 15 years? Global macro scenarios. What's happening in the economy? Of course. Benchmarks. Are we trying to follow certain benchmarks? Are we trying to follow certain risk drivers? And how do these things, when we're evaluating the situation, you start here at the high. Then, if we're evaluating investment, what benchmark can we look at to see how it's doing compared to their peers and their indexes? A strategic asset allocation. So an example of that might be, I like growth stocks, but I also like value stocks. How much do I want? Maybe I want of my allocation, 40% to value, 60 to growth. Maybe I want it even, that type of thing. Then tactical asset allocation. So really moving around within segments, and even on the, think of strategic this way, where it's very much the sector. Down here, this is the actual security we chose, whether it be we're choosing an ETF, a mutual fund, or an individual security. And then finally, risk management. And when you peel all those together, you kind of get a look of how to really evaluate investment and follow a process that goes beyond simply what were the returns, or every month we're going to do this, or every quarter we're going to do this. What you really get is a process that's driven by these first two, which is long-term capital outlooks and global macro scenarios. And where that leads us, and we'll go into fixed income in a second here, but with our equity thesis, basically y'all can read this slide, but right now, Fed remains tight. Tone, this is back in April. Obviously, May, it seems a little different, but they had shifted a little bit towards the end to mid of April, dovish on the Fed part. Weren't saying they're going to raise, but certainly saying they're not going to, or excuse me, the reverse, not saying they're going to cut, but certainly saying they're not going to raise was positive. Soft landing prospect improving, near term, but global macro and election cycle risks above average. Certainly the macro is, when we get to investments, That's always present. I don't know that I'd really say it's above average, and I don't have to agree with everyone on the slide either. And inflation falling globally, that is very true, and that is the biggest economic catalyst to why we might see some lowering rates. So given all this backdrop, here's what we're seeing on the equity side, okay? And I will pause for any thoughts or questions on equity investing. Anything in chat, Juliana?
Not that I know of right now, but there's a lot of people that joined the meeting, which is great.
Well, good. Just shows yet again in life, sometimes you're better off procrastinating. We should just wait until 12:10. No, or 2:10, I'm sorry. All right, just checking. All right, let's go to fixed income now. And you're going to see a couple more slides on that. But monetary policy is expected to ease from current levels, but rates remain high and elevated for longer. Absolutely. One thing we've done even since the beginning of this month, shorter duration positioning remains prudent. However, curve steepening presents opportunities to extend duration. Notice that investment application. We have extended duration a little bit this month, added some mortgage-backed securities in order to do that. And credit spreads remain historically tight. Corporate bonds and income for investment grade generally remain healthy. What they mean by tight is there's not a huge spread saying there's a lot of credit risk here versus buying something of lower risk, such as a U.S. Treasury. So with that in mind, facing the same backdrop, what we really have here all of a sudden now is some expectations and opportunity to really go and you get a decent yield of 4 to 6%, even without any moves in interest rates. All right, so now we're talking long-term assumptions of the market. I thought this being the first step we look at is obviously very important. So let's go to why this is important. And also what I want to show is just the huge variance you can see. So, one of the things that's most important about true expectations of the future is without them, you really can't allocate a portfolio based on risk. Because a great example would be if I had no reason to expect the stock to return more than a U.S. Treasury, why would I ever own that share of stock versus just owning a risk-free U.S. Treasury? I wouldn't. And so when you look at that, you have to understand that if people are taking more risk, it needs to have prudent return. And so these expectations are very important because now we got to see how much added return. So for example, if I can earn 5% in CDs and treasuries, but I can only earn 7% in stocks. Well, that might not be that appealing for me to take the added volatility versus going low risk. But if I can earn 5% in CDs and treasuries, but 10% in stocks, now all of a sudden I feel really good about having some towards the conservative side of the treasuries and CDs and some towards the equities. Now on these long-term capital market assumptions, if you look at it, one of the things I wanted to say, obviously all of these are positive. And when you look at this across these different managers, you do see some pretty big variance, right? I mean, so we have JP Morgan and we have Vanguard, both highly respected, both really, common firms. I mean, you look at the difference in U.S. large cap, 7 to 4.2 to 6.2. And I love how Vanguard gives a range here. I mean, that's a big difference. 4.2 to 7 is huge in U.S. large cap, which is a pretty efficient space. I find this one really interesting. Vanguard's difference in perspective versus JP Morgan. A lot of that has to do with the work I think they do in the space. And then this one, they're a little bit more together when it gets down here. So anyway, as you see, all of it positive. And one thing I will say with analysts on Wall Street, if you watch them enough over time, these numbers right here, the 10-year average, they'd rather be proven low than high. So they're going to do that for you. And then on that projection aspect, I just thought this was interesting as we go into the advanced planning topic, which is, and it's kind of where we started, where people are trying to predict when the Fed comes down. This is projected change in S&P 500 by the end of this year. So we have all the way from positive 9% at Oppenheimer, all the way down to negative 12 for some reason at JP Morgan. Here's what I would say when you look at a chart like this, because you can find these anywhere. You can find them on Google. You can find them on Wall Street Journal. You can find them on CNBC.com. You can find them wherever you want to go. And one thing I would look at on this, I would not pay attention to the numbers, first of all. I just wouldn't. I don't think any of these numbers in the middle here, this percentage expectation, are well enough thought out or well enough informed to be accurate, more so for a company. I'll give you an example like Morgan Stanley versus a company like Bank of America. Yet they came out with vastly different numbers. Okay. So what I would watch though, when I see charts like this, and this makes a big difference, is how are people moving from where they are? So if I see this chart again in 2 months and JP Morgan all of a sudden has moved from anticipating 11.9 down to only 3% down, now all of a sudden I got some movement where JP Morgan is thinking, wow, better things are about to happen. If all of a sudden Oppenheimer does a downgrade of their estimate, all right, I got some movement where they're telling me something. So you watch the upgrades and downgrades, and you also watch when they're outliers, 1 or 2 people willing to do it versus a large group. And a lot of times those people are kind of right. They just, there's a lot of times people on Wall Street are a little hesitant to be they often say the cutting edge is often the bleeding edge. They don't want to be out running too far outside the pack, if that makes sense. So anyway, hope y'all like that. Now let's go into a little bit of why I'm talking now about the fixed income being such a great opportunity. If you come back here, and monetary levels remain elevated for longer, I'm saying, yeah, if they might remain elevated for longer, you're going to be able to just sit there and clip a 4 to 6% coupon. It's going to be good. Well, what happens when rates actually go down? And this is one of my favorite charts ever. And I've been using this right and left. And think about this in your own life, as well as a lot of people you care about. This is a great opportunity for you to help people who might be reading Money Magazine or, whatever the popular financial du jour is. A lot of people are running into CDs right now. And a lot of times when people run into things and talk a lot about them, it's kind of an indication that there might be a bubble there and they're a little bit overly inflated. And second, it might not be the best investment in the world. You think about the stuff that people really enjoy talking about. And a lot of times a few years later, it's kind of like, No, not all the time. I'm waiting for the to happen on crypto. Hadn't seen it happen yet, but I'm just waiting on it. But it would follow this model. I certainly, you go back and the idea of tech stocks in late 90s, you'll know what I'm talking about. You go to 2006, 7, and 8 with real estate, and everybody owns 3 condos and has written them out. Probably not going to last forever. But this is the big plus. This is the big thing that gets us excited about bonds. And this shows what will happen on interest rates if they rise or fall within a certain range. So on the left here, we have, in black or gray, and actually on that leverage loan had it climbing. But on the gray side, we have how much it'll lose if rates go up 1%. And that's not meaning it loses the yield. It just loses capital appreciation. So for example, and I'm just going to make this number up. Let's say a 10-year treasury is earning me 4.8%. And I hold it, but rates go up 4%. I didn't lose money. I made 0.8%. I lost the 4%, but made 0.8. Now, on the other hand, if rates go down, I got my yield of the 4.8% plus the capital appreciation you're seeing here. That's a spectacular return. And that's what makes these things shine over CDs, especially also when you then think that treasuries are actually more risk-free than CDs, since the person backing or the entity backing up the FDIC is the U.S. government. I would consider a U.S. Treasury even lower risk. Makes them a great investment right now. So anyway, I wanted to show you all this. I personally have to reflect when I look at this 10-year number and 30-year number, just how big this capital appreciation can be. And part of the reason why, guys, and I mean this, I think y'all have been impacted by the same thing. Guys, we haven't witnessed what happens to bonds in an interest rate decreasing scenario in almost 14 years. Actually, it's more like 16, back to 08. That's a long time, and so we're not used to that, and we're about to experience it, and I think y'all will like it when it happens. All right, and so Yeah, that's on the mortgage stuff. I'll skip that. That's a little heady. Let's get into some advanced planning. All right, Julian, do we have anything in chat before I move forward?
You do not right now, but I'm
Okay.
watching. But if you do, please unmute yourself or type something in the chat.
Or would anybody like to ask a question before we go on to this planning idea? I'd love to have it. It makes it more interesting if it's not just me talking. All right. Well, we'll go into advanced planning here. All right. So let's look at the elections. And here's where I want to take this to really make it an advanced planning tool. And this is. And I think this is an asset protection tool. I think this can be an estate planning tool. I think this can be make your money go further tool. And it can even be a charitable giving tool, which is how do we manage our behavioral finances this year so that we do what's most important to us and keep on focus and on path to meet my goals and my family's goals without letting the noise of the world derail me. I think of a lot of this, what I'm saying is just stay focused. Just stay focused. Not to go too spiritual on this, but I think back to, and part of this is I'm watching The Chosen, but when you think about stay focused, and for The Chosen, those that don't know, it's a show about Jesus and his disciples. It's really great. And one of the scenes in there is when Peter gets out and walks on water, as long as he's focused on Jesus, he walks on the water. The second he looks at the water and figures out what's actually going on around him, he sinks. And that's a metaphor or a lesson for all of us, because as soon as you stay focused on your goals and what really matters, which we've talked a lot about, you're going to stay on your goals and we're going to have a plan that works, regardless of who gets elected in November, or else it's not much of a plan. Think about it. If you had a financial plan and you had to change how that financial plan worked significantly, I'm using the word significant because you do have to change it over time, regardless of elections. But if you had to make significant changes based on an election that happens in the United States to your investment portfolio, you're either one of two things has either happened. One, you have a very weird portfolio, or two, we got bigger problems here than your portfolio because something weird's going on with our country. And I know that might not sound right, but think of it this way. What we have, even with these two folks, is maybe, a scenario, and I'm not going to say one candidate versus the other, but maybe a scenario where one candidate makes the market go up 10%, the other might make it go up 8%. And you can choose which candidate that is based on which candidate you prefer. But in both scenarios, we're making money. And it may even not be as significant as that. So what I'm going to show y'all here is some long-term trends that really prove the stock market's pretty politically agnostic. And isn't that nice? I mean, think about the stock market like a welcome friend right now. Wouldn't all of us like more of the world to just be politically agnostic? Are you not tired of hearing all this divisiveness in our country? So what happens in election years? And we're just showing you monthly returns on average for election years. Now, back to what is a correlation and what's not. I have no idea if this is because of election years at all or just what happens those years, but I will tell you this. On average, if you do this exact same study of all years since 1950, almost all years have the fourth quarter is the strongest quarter of the year. So it's not all the time, but it's not odd for that to happen. But in election years, fourth quarter does tend to stand out as being the best returns. Also remember this, and this is why I made it a behavioral finance issue. A lot of it's about exploiting fears and biases, and those are bigger than we think. They get us on a lot of levels. And remember, when you're watching the news or trying to look at news outlets about financial information, what they really want is clicks and viewers so they can sell ads. They don't care if they give you the best news. They care about giving you the news that'll make you stay on their station. And remember that, because fear, and I even think about this as a financial advisor, I know darn well I watch CNBC more if the market's going down than if the market's going up. I just do. And so what they want to do is do whatever they can to make me watch it more. So they're going to play on your fears. I then had this little chart. This is honestly, and I think I can do this. Hold on a second. Since I have you guys here, I'm going to do this. All right, y'all are not seeing my screen, correct, Juliana?
That is correct.
Good. All right. This is just good investing 101 I'm about to give you here. So let's zoom in and we'll talk about it. All right. So who wants a prize before I give you all good old investing 101? Anybody want a prize?
Well,
Sure.
we can ask him to put it on the chat for whoever answered correctly.
All right,
Then
here's
we'll
all
just
it
do
is.
a
We'll
quick.
put it on the chat. All right, so if you think about right now, let's talk about everything wrong. We could even have a fun game if y'all are sitting around a table and talk about everything wrong that might make your portfolio go down. Anybody want to tell me a few? Play a little game.
What was
Okay.
the question?
Tell me some reasons of things going on in the world right now that might make your portfolio go down.
Okay.
Somebody's got this.
This person said war.
Yep, war. That's a great one. What else we got?
Michael is typing diligently. Interest rates go
Interest
down.
rates? Ooh, that would be awesome. That would help our economy and markets go up. I would say make it go down. Anybody? I have the best clients in the world. Y'all aren't worried about anything. I apparently trained y'all too well. But yeah, there's a lot going on right now, right? We got China issues. Oh, more bank failures. Yep. Hey, you guys, it's like I've scripted y'all into doing this well. Okay, anybody else got a problem with the world right now? Anybody? Festivus, U.S. default on loans. All right, Peggy said that. Do you want to elaborate? Because if you're talking U.S. debt, that's one thing. If you're talking something else, that's different. I was about to try to come up with something. Yes, the U.S. debt. Well, we got big issues if that happens. Yeah, that's a problem. I don't see a reason why we'd economically default on debt, but we could choose to, obviously. Anybody else? In fact, actually, Peggy, on a funny note on that, and I don't read a lot of these, but I read this one because I thought it was such oh yeah, amen, Peggy, that is something. I thought it was such a big event when the U.S. got downgraded, and I loved reading the S&P opinion on why they downgraded the U.S. outside of AAA. Had nothing to do with our financial situation, by the way. It had to do, oh, that's hilarious. Somebody said change the metric system again. I doubt that would impact our portfolio, but it would make the world an easier place. Yeah, so the reason we initially got downgraded, and I think this is still the biggest issue with our debt, is the idea that the threat to default is not AAA. Think about that. I love that reasoning. The threat to default is not AAA. So the second you say, nope, I'm not going to pay that, they'll knock you down. Which makes a lot of sense because I'm in a lot worse economic shape than the U.S. federal government, but I never call and threaten my mortgage company and go, you know what, I'm just not paying this month. And it's like, what do I expect is going to happen if I do that? No, I'm going to pay it or else they're going to come get my house. Well, great, we cannot pay our debt, then they get our country. I mean, that's not a good thing. And if you actually really look at it, and I don't mean that like overnight, like they just come and get your country the way they foreclosed it, but it actually is what would happen long term, because whereas it might not really happen, if we defaulted, we wouldn't be able to fund our military. I'm not saying we couldn't defend it if we're in a war against Mexico and we need to keep them out, but we're not going to be able to be a worldwide power the way we are, and all these other stuff. So anyway, cool. That's why I think. All right. So here's the crux of this. Everything that's possibly wrong now. We got war, we got interest rates, we got government elections, we got inflation, we got COVID, we got whatever else. It's actually not that bad. It's not that bad. And it's hard for us to get our heads around that because it's what we're living in, and our minds tend to take risks and make them extreme. So a good example for that would be, and I'll just take you where we're at now, risks that are extreme. Oh, this is such a good example. I'm going to stop this. All right, think about this story. My father-in-law went to Florida State University in the 1960s on a football scholarship, stayed in an athletic dorm that did not have air conditioning. That wasn't even considered a risk back then. Now we'd be like, oh my God, these children are going to die. You know? And so when you think about it, a lot of times our risks are a matter of our perception. Same with our fear. And so what they've done in this chart is they went back on one of their mutual funds. This is American funds. And they went back to 1934 with $10,000. And if you'd invested it along the way, how much would that be worth now? And what they found out was it's worth about 197 million if you reinvest the dividends. It'd be worth about 17 million if you did. That's a big difference. That's a huge amount of compounding interest. And their thesis, it's also Warren Buffett's thesis, is if you just buy into the market and hold it, it's going to be nearly impossible to actually lose money over time. So I took this and I went back year by year, and we can give this slide to any of you guys. If you ask Juliana, I'll email it to you, or heck, we have in our conference room even a big version of this that if you guys want it, you can hang it on your wall in your basement or something. So take it back to, when did the world actually look scary? I mean, if I'm saying now's not scary, what was a really bad time? Well, the year that comes to mind is 1944. If you think about this, the 1920s happened. All kinds of weird things happened in the 1920s. We had a pandemic, a lot like what we do now. We had a huge stock market bubble prompted by a lot of technology like we did in the late 90s. They were buying stocks over the phone. We were buying stocks on computers. Then that followed by a depression, a stock market crash, which then started building up and crashed again after 1934 to 1937. We all know that story. Think about it now, what we have. 1938, we're going to go 38 to 44 and talk about where we are now compared to then. War clouds gather in Europe. 1939, war starts in Europe. We're not talking Ukraine and Russia. We're talking big boy Europe from an economic standpoint. They were bigger than the United States at this point in time. France falls. This is not, Israel takes over Palestine, or, Palestine shoots a bomb into Israel, or Iran sending a drone over that we shoot down. I mean, this is France falling. Pearl Harbor. This isn't, some random terrorist attack in a part of the Middle East. This is U.S. soil, an act of war. Only time it's ever happened. Wartime price containers. Now, this is controls. This is something, if you actually look through our history from about 1940 to the late 60s, you'll find a lot of things that we were a very socialized country. We just didn't acknowledge it or realize it. This is one of them. It started to help with inflation. We had wartime price controls. Okay, so what happens when you have price controls? We're about to see in a little bit all kinds of problems a few years later. Control stuff, it impacts the market. People stop producing things, a lot like they did in COVID. What that lead to in COVID? Something you're going to see here. Then we have in 1943, industry mobilization. This is the start of our recovery. And it's us building an infrastructure to build industrial things that can help us get into the war. And then eventually, when those people came home, was sort of the industrial backbone of the United States. And get this, we got kind of lucky that all of Europe had been blown up. And so basically from 1944 till now, we've been the economic envy of the world, given all that stuff. But if you look at it through here, they had rampant inflation in this time. They made the mistake of raising interest rates instead of lowering them. And then you look through all these years, there was never, let's look at some of these here. There was never a time that just looks completely safe. And when you come back to civil unrest, yeah, we had Black Lives Matter. Guys, remember what this was like. Kennedy assassination, that had to be scary. I wasn't there, obviously, but I mean, you think about economic or political turmoil, and then Cuban Missile Crisis. This is way scarier than what's going on in the world now. These guys were actually like 90 miles away from us, aiming bombs at us. So all that to say, it's always negative and seems to always go up. Don't let the behavioral finance and the biases get in your way. Okay. And then finally here, average returns in election years, as you can see, it tends to be kind of middle in presidential elections, but it's positive whether it's a non-election year, midterm, or presidential election. So I will pause for any thoughts on this slide. Here you can see the wonderful, S&P 500 through various administrations. One of the things you'll find is it has made money through Democrats and Republicans alike and on a similar basis. And a lot of times, if you look at any president, you can look at their administration, and often what happened prior to them even getting into office drives the performance of the market every bit as much as what happened while they're in office. That's it. So as you see here, it's done pretty good over both parties. Then you got, I always feel bad for George Bush here. I think he was a good president economically. The poor guy got hit with 9/11 and the Twin Towers and the tech bubble, and then the great financial crisis, neither of which were his fault, but that's why his was so weird. Now slide then, we'll skip that. All right, so before we jump over, we got some relationship management, and spring home buying season is here. So I will pause for any thoughts and questions from you guys, and then we will get into some real estate stuff. All right, guess we don't have much there. All right, so Sonya, give us, and I have a few questions I have picked out specifically for our clients, but we'll go ahead and put up a little bit of your bio and just tell us who you are, your background, and then I'll ask you some client-specific stuff.
Okay, great. Thank you, David. Sure, my name is Sonya Martinez. I'm a realtor with Keller Williams First Atlanta. We're located in Sandy Springs, and I work with buyers, sellers, and investors alike. I love all things real estate. And when I'm not working, I'm usually with my family or I'm up in the mountains. I love to hike and camp, but I love all things real estate. I'm also part of a nationwide real estate women's investors network.
All right, very good. Well, I'm going to put this down so they can actually see us talk, maybe blow you up and all that. But, all right, so this is a question we didn't really approach in our pre-interview, but seeing Juliana's beautiful picture made me think of it, where she said, it's spring buying season, right? So let's think of a couple things real quick. Let's start with curb appeal, okay? If somebody's selling their house, or just as importantly, has a child or a friend who's selling their house and wants to give them some perks, curb appeal, what are things that stand out and actually move the needle,
Absolutely. Curb appeal is very important. It's the initial vibe and feel that you get when you walk up to a home. So it's very important to have nice curb appeal, to have a nice fresh paint on the house. Your lawn, your landscape, everything should look nice. The pavement, it's the initial feeling that a buyer gets when they approach a home. So it's very important to have a good curb appeal. And it's great now because the flowers are blooming. So it's actually ideal.
Okay. One of the things I know with our clients that, it's like they retire and they love doing real estate moves at the same time, right? Some don't do anything. And then some do, one of the next two things I'll take you through. A lot of times I find people, I guess, 'cause they're spending time at home, wanting to do some big renovations. Talk about what are the renovations people can do that they actually get their money out of when they then go to sell.
Absolutely. Sure. So renovations are really important. If someone is considering downsizing, and they want to sell a home, we analyze what a home is going to sell for as is, meaning without renovations or repairs versus a home that's renovated and has repairs. I always recommend doing the renovations and repairs because you don't want to leave any money on the table, essentially. So I always recommend the renovations that you can get the most money out of is, and in order, number one is the kitchen. So families migrate in the kitchen. It's where everyone gravitates to the kitchen. And so if a buyer walks in a home and they see that the kitchen is not renovated, they immediately think, wow, this is a big cost. So you get the most return on investment with the kitchen as number one. Number two is the bathrooms. So the bathrooms is number two. These are always the top two renovation projects that should be done when considering any renovations at all, because they're high ticket items. So it would be kitchens first, the bathrooms next. Also, if you have a basement or an attic that is unfinished, I always recommend finishing those two, because
That's
it's gonna
cool.
provide more square footage of living space for family, and essentially it's gonna give you more money when for the sale of the house. When you finish off an attic or a basement. So kitchen, bathrooms, attic, basement, and then we have deck. So deck also provides more living space for family or individuals. It's not indoor space, but it's outdoor space. So if you don't have a deck, highly recommend putting in a deck or extending a deck, or making sure that the deck is looking great for a potential buyer. So the deck is next, and then we talk about curb appeal. Of course, that's really important. And I think lastly, I would say energy efficiency. So a lot of buyers are looking for that. There's a lot of energy efficient products that are out there, and everyone's into that today. So we're talking about maybe energy efficient windows and or devices throughout the house. Maybe solar panels, those kind of energy efficient items.
Okay.
I would say in that order. That's important.
Well, I always love when other professionals just validate my own bad behavioral finance. So, back to that concept. You said deck, and that's the project we need to do this year. So I'll validate this in my mind that I'm not spending money, I'm investing it on my deck.
Absolutely.
Yeah,
Absolutely.
I'll tell myself that. Thank you.
Yeah, you
It's
want
the kind
to
of thing that makes you buy a deck that's, or rebuild a deck that's too nice for your budget.
yeah. Well, you want to in extending a deck or adding a deck or fixing a deck. It's extending living space, which is
Yeah,
always going to add value to property, to properties.
that makes a lot of sense. Living space. Yeah, so the deck, they do consider that living space, don't they? Kind of.
Absolutely, it's outdoor living space.
Yeah. What about for people and folks here are kind of struggling with this aspect of it right now, trying to do the downsize. And part of that is new construction is just so expensive, and maybe they have an older home, they don't need all this room. But what are you seeing with your clients and trends in the industry?
In regards to downsizing.
Yeah, yeah. So let's say you're 65 years old, you maybe want to consider either moving into a retirement home or maybe like to a townhome, or have a big old 5-bedroom house in Milton, Georgia. My wife and I really only need 2 or 3 bedrooms. We don't
Right.
want to maintain all that space, so we want to sell it, but everything's so expensive. What do you think people do?
Well, if someone is looking to downsize, so if you're retired or close to retirement, then you may be considering downsizing. And so the reason being, you may be looking for a home that has lower maintenance on it. It's going to be a little bit more manageable, or maybe you need to move to be closer to family, or maybe healthcare facilities, right? So there's a lot of reasons people will downsize. But think about this: when you're downsizing, and yeah, property values are higher, but you're selling your current home, so you're gonna get money from from the sale of a current home, and you're downsizing into a smaller home. The financial implications of that is, I mean, I think it's, if you need to downsize, then people downsize, right?
Yeah,
So
you can.
Yeah, and there are a number of really great places that are really great for retiring, and that depends on you. Like, if you are you looking for, are you looking to downsize to the city, or do you want to be in the mountains, or do you want to be somewhere in between? So there are a number of really wonderful high-end places that people like to retire to in the state of Georgia. So I think
Okay.
you can offset the cost because you're selling your property. That's a larger property, right? So
Hopefully so. Yeah. A lot of times I've seen people move in without, they get the upgrades, right?
and
And
then
and
they're
then
like, I
something
love
you
it, I don't
just
want to leave.
yeah, absolutely. Now you mentioned something interesting. I think they just be interested in this because whenever you go into a transaction, you always want to know how the market works, whether it matters or not. You mentioned something changing about real estate commissions. Tell us about that.
Oh, sure. Oh, yeah, that's a big deal right now. It's the NAR lawsuits that is in regards to the commissions. So, in the past, a lot of buyers had a lot of costs, right? It costs a lot of money to buy purchase a property. You have your down payment, you have your closing costs and commissions. So I don't know the exact year, but a long time ago, they wanted to make it fair on both sides of the transaction. So they made it so that on the seller side, the seller pays commissions, which is approximately 6%. And then that way, as a buyer, at minimum, you're paying about 7% of a purchase price, right? So at minimum, your down payment is about 3.5%, and your closing costs are approximately 3.5%. You have costs associated with lender fees, attorney fees, your taxes, your insurance, your appraisal, your inspection. So that's about 7%. So to make it fair on both sides, it's sellers paying commissions at 6%, and the buyers are taking care of their closing costs, which is a minimum of 7%. So now they've changed that. So come July 1st of this year, which is around the corner, the buyer is responsible for their agent's commissions. So I mean, this may be an issue, because now a buyer is having to come to the table with a minimum of 10.5% in order to buy a property at minimum. So what that looks like is it's more conversations, right? So like having conversations with the buyer, like, hey, are you willing to pay the commissions? What I plan to do is, when I'm on the seller side, is have the conversations with my seller, and to say, hey guys, just pay the 6%, because what happens is, if you're only paying your agent's commissions and not the buyer's agent commissions, you're going to be losing a lot of the buyer pool, because now that buyer that was able to afford the home, now they may not be able to afford the home, because now they're having to pay commissions as well on top of the closing costs that they are responsible for. So instead of 100 buyers, now you may have 25, right? And that's never good when you're trying to sell a home, because you're not going to generate um, expectations or multiple offer situations for your house. So my plan is to have more conversations on the seller side as well as the buyer side in regards to the changes that are coming up July 1st.
Okay. That's great. That's huge difference.
Oh yeah. It's gonna be interesting.
Just for people who might be in that scenario or know people that are, does it matter when you finalize your contract or is it when the house closes?
It matters in the beginning, because, for example, it matters in the very beginning, because if a buyer is not willing to pay the buyer commissions, I could say, you know what, then let's just see the properties that you're interested in, and then I would have a conversation with the seller. When I say seller, I mean the seller's agent. We never talk to the seller, right? It's agent to agent. I would have conversations with the agent, and I would say, hey, is your seller willing to pay commissions? If the seller is not willing to pay commissions and the buyer is not willing to pay commissions, then we're not showing that property. That's what I mean when I say that the seller's going to lose a lot of buyers if that happens. Because I mean, nobody works for free. You know, if the seller's not paying commission and the buyer's not paying commissions, nobody's paying commissions. So
Yeah.
that's gonna be really interesting. It's gonna be a lot more conversations for the agents between their buyers and their sellers.
Hmm.
Yeah.
Just question, and could be coming from my evil side of the business, but is it always like set that they split that down the middle, or is it ever a conversation like the selling agent might get more or the buying agent might get more?
Sure. So the typical commissions is 6%. That's the common commission base. You know, when I work with a client and someone that I've worked with before, I might say, hey, you know, you're selling your house and now you're buying your house. So I might give them a break on commission. I'll take that break. I won't reflect that on the buyer's agent, right?
Hmm.
I want a lot of attraction for my client, for my seller. So it's usually half, you know, it's
Hmm.
split it in the middle. But let's say a seller's only willing to pay 5%, then that's going to look like 2.5 on each side, right? But one thing that I do is, let's say I'm selling a property for a client and I have an open house and someone comes in without an agent and they're like, hey, I don't have an agent. Can you just write up the contract for me? What that means is I'm representing both sides, but I'm representing my client, my seller as a client, and I'm representing the buyer without an agent as a customer. So,
Hmm.
you know, I'm always going to have my client's best interest. If that happens, that means that essentially that I keep the whole 6%. So I don't think that's fair. So what I typically do if that happens is I lower my commissions. At the end of the day, it's gonna help the seller. They're gonna pay less in commissions. I'm gonna make more. They're gonna pay less. It's a win-win for everybody. So that's what I do. But typically you
Yeah.
split the commissions in half, and it's typically 6%.
Okay.
Yeah.
Now you mentioned rental real estate. What are you seeing there? And that area to me is one of the areas that I would find hardest for our clients with rates higher, because borrowing for a rental typically is going to be a little bit higher rate than a primary residence. And, I don't think credit conditions are all that tight, but with rates high, just what are you seeing in that market? Is there still a lot of interest or not so
Sure.
much?
Oh, I mean, definitely and for sure. So what's going on in the rental arena? A lot of states are cracking down on the Airbnb situations. There's too many Airbnbs out there, and it's causing an issue with homeowners. So it's low inventory. All of these investors are buying properties for Airbnb. So a lot of cities, a lot of states
Mhm.
are cracking down on Airbnbs. However, the rental industry is still strong. What I am seeing is a little bit of a change in regards to that rental uh, property, because what people are doing, instead of buying properties for long-term rentals, they're doing more like, I don't know if you ever heard of a pad split situation. So
Tell us.
it's sort of like providing a solutions for a lot of parts of Georgia, a lot of areas, because rents are increasing year after year. They're getting kind of ridiculous. So rents are increasing year after year. So what a pad split situation does is it allows for a property to be rented out for not one family or person, but rather like multiple people. It's called pad split, and it allows for like professionals to be able to have affordable housing. So that's
Oh,
yeah, it's a very interesting
that's,
strategy.
oh, you said pad split.
Pad split,
That's a cool
like
strategy. Sounds
like
like,
splitting a
it's
pad.
interesting. I heard a statement this or last week actually, at the FPA, that very few things are irrational. You just don't know the backstory. And it sounds like what people have been doing in like on the West Coast and Japan for decades.
Absolutely. Right. That's what people are saying. Like, oh, this has been going on this is what we do. This is exactly what we do. So
Yeah.
it's becoming more and more more of a reality here. I'm actually looking at a past split situation right now. I have a meeting on Monday. But whereas I would be able to, and then on the flip side of that, right, as an investor, if I were to, I looked at this property and I would be able to get about, $2,500 in rental income as a long-term rental. But as a pad split strategy, I'm actually going to be making $4,600 conservatively.
Wow.
Yes, because now it's not one family, one person. You're splitting up the home. And I'm looking at like turning it into like a 6 unit within the home. It's a good size. It already has 4 bedrooms, 3 bathrooms. So I'm going to add 2 more bedrooms. I'm going to convert the living room into 2 bedrooms and make it a 6 bedroom. And then, get a lot more rent for it. But it's also solving an issue that we have here with affordable housing.
Yeah. Well, that's really cool. Oh, sorry.
Yeah.
That's hilarious. Siri said there's no one in my contacts named affordable housing. Well, I know that, Siri. I've been trying to afford one for a while. They're expensive.
Absolutely. Yeah. And as a regular investor, I wanted to just touch on that. Yeah, sure. As a regular investor, if you're buying a property, if you want to buy a property as an investment, the interest rates are higher, of course. And you usually will get an 80% loan. So you need to come up with 20% in most cases. And of course, the interest rate is a lot higher. So yeah, you have to take all those things into consideration.
Yeah. Well, and that's interesting to say too, because it's a lot of down payment. I mean, what's really made so much of real estate work so well for people over the years is the leverage. But it's not an approachable amount. It doesn't mean it's wrong. It just means it's different than it was about 3 years ago, right? A lot of things with interest rates are. All right.
Yeah.
Sonya, you've been wonderful. We'll have you back. And please, if anybody wants to reach out for her, anything real estate wise, I believe we have your contact information. Hold on a second, I'm gonna put it back up. Because we thank her for giving us her time, but we also want to help you guys and help her if anybody needs assistance in that area.
Thanks for having me, David.
Yeah, absolutely. So here's her number if any of y'all need to get in touch with her, email, but at the same time, you can do that through us. And, just really trying to think about all y'all's different sides of net worth. And certainly all of us have. Oh, one last really good one we'll talk about that I hear about all the time, and they always forget to retitle it. What about owning their real estate? And sorry, we had pre-interviewed this and I curveballed you. What about owning it in a revocable living trust versus just outright if it's either real estate or personal property?
Oh, sure. Sure, we can touch on that. So if you have a property, and I'm gonna go down a list of pros and cons of having a trust, and why it's good, advantageous, and what's not good about it. So having a trust for your property. The good things about having a trust is that you avoid probate, right? So a lot of times your property can be subject to probate, which is really time consuming and very expensive. Speed, so your beneficiaries don't have to wait for a probate court. They can generally take possession of the house sooner than they would have otherwise. Privacy, a trust, assets don't become public records the way probated assets do. Protection of assets during the trust creator's lifetime. So if you become incapacitated, the trustee's job is to maintain the house on behalf of yourself and the person that you've chosen to inherit the property. And then also there are estate tax and creditor advantages. So when you place your house in a trust, you may have advantages to potentially shield the property from lawsuits and creditors, right? So these are the advantages of having your property in a trust. Some of the disadvantages of having your property in the trust is The number one being expense. So it's typically more expensive creating a trust than you would have with a will. Loss of control. So you need to figure out if you're going to have, like, what type of trust you're going to have. Is it going to be a revocable trust or irrevocable trust? Because you lose some kind of control having it in an irrevocable trust. You would have to get permission if you want to make any changes and such. So you lose a little bit of control. And then even if your house is in a trust, that doesn't mean that your other assets are protected. So you need to make sure that your other assets, everything is listed in the trust that you create. In addition, if you have 401s, IRAs, and life insurance policies, usually they'll require that you list the beneficiaries in these designated places for protection. And then the only other thing that you have to consider when you have a property in a trust is that you may lose the homestead exemption. You all know that if you have a home, you want to have homestead exemption, especially if it's your primary residence, so that you can get tax benefits. But if you have the house in a trust, you may lose some of those homestead exemption benefits. So you would have to have an affidavit to make sure that you can benefit from that.
Thank you. That's great. Actually, on the homestead, that's an easy one to overlook or be in an administrative trouble. So, well, thank you so much. And guys, we're at the end of the hour. Obviously, went a little long today. Sorry about that. But we will go ahead and wrap up. We'll be here again next month. Please let us know any topics, questions, speakers you think would be great to have on. Thank you all for your time. Thank you, Sonya. And we'll see y'all next month.